one of the things we're real excited about this year is our 15-year anniversary. I mean, Matt, you've been 20 years in the industry. There's been a lot of things that have happened, a lot of changes over the last 15 or 20 years. Matt, would you share a little bit about some of the things that you've seen really change?
Yeah, it's been a fun ride.
Yeah.
Right. You know, as a firm, this year I think we'll go well over 2,000 clients that we've helped with their retirement planning and hopes and dreams, things like that. But it's funny, if you look back 15 to 20 years ago when I started, there are so many things that have changed. The internet really, emails were kind of in their
What's an email?
In their infancy.
Yeah.
I remember when I got my first job at a big firm, they assigned me an email address, and I didn't understand why would I ever use this, right? I'll just mail a letter if I need to send something to somebody. But
you get that nice tone from
the dial-up and everything. And we don't hear that anymore. But it's pretty phenomenal, the changes that have taken place with our clients. Yeah. When I came in the industry back in the 90s, everybody was really caught up on accumulating their retirement nest egg. And we were going through the 90s where you could kind of just throw darts at a dartboard and stocks would go up 10, 15, 20, 25%.
Yeah.
I would actually meet with people when I first got started in the industry, and I was always a student of the markets. So I knew that the bull run that we were having really from the 80s into the 90s, I knew it wasn't going to last forever. But you had individuals that just expected that the stock market was going to go up 15% every year. And if you weren't getting at least 15%, they weren't interested in talking to you because they thought it would just continue on forever.
All you had to do was put .com on the end of it.
Yeah,
and you get 15%. So.
The company didn't even have to make any money.
It
was worth $1 billion. So things have changed. So obviously, I think there's been a shift in mindsets from 15% rate of returns to something that's more reasonable, where individuals now, especially as they get closer and into retirement, are really just looking for investments or vehicles where they can keep up and outpace inflation. The returns, instead of 15%, maybe they're shooting for 5 to 10% or something like that. 6 to 8% is a little more reasonable. But I think one of the big things that has changed as well is just how much more information is available to the consumer, the investor, the retiree, whatever you want to call it. And I think the information age, some of that is good, but I think also some of it can be a little bit dangerous. Because if you go out, I haven't done it recently, but I think if you go out and you Google financial planning or retirement planning, I would think that the number of hits that would generate has to be in the millions, right? And there's going to probably be some good information that's out there, but you might have some information that's out there that's maybe written by somebody that doesn't have that much experience. So there's a lot more information out there, and I think people feel empowered with that information, and a certain amount of that is good. I've always said that Google's a great place to go get a recipe for dinner tonight, but it might not be the ultimate authority on your investments and your retirement planning. And then I think probably the other really large issue is the change in demographics. So obviously we've all seen the statistics of, I think every day 10,000 people turn 65. So now the baby boomers, who generated a lot of the growth in the economy up until the last 5 to 10 years through their consumption of hitting their peak income earning years, they're now shifting from a consumption and accumulation mindset into a preservation and income mindset. So the thought processing from a lot of individuals has changed, and that's also driving changes in the investment marketplace. It used to be that everybody just threw money into a diversified mutual fund portfolio, and that's all that was really available. Whereas today, you don't have to write it out and hope things are going to work. You've got different instruments that can guarantee income for life. You've got instruments that can participate when the market is good, but have protection when the market's not good. Individuals have gotten much better, much more knowledgeable about things like fees and expenses and keeping costs low and understanding the impact of having a high fee account over time. So the industry, the options that are available from firms on Wall Street or insurance companies or even the banking industry, there's been a whole lot of evolution over the last 15 to 20 years, and it's been an exciting ride. But obviously, I also think it's going to be exciting to see what we can help and accomplish with our clients over the next 15 to 20 years as well.
Something else, 15, 20 years ago, I mean, 80% of people retiring had pensions.
That's a good point.
Yeah, that's basically
Yeah.
a thing of the past almost.
Almost, yeah. If you've got a pension, you're extremely fortunate,
Yeah.
especially in the private sector. Obviously, pensions are still around somewhat with different government jobs.
Yeah.
But yeah, I mean, for the most part, that used to be the kind of the number one. If you look at retirement planning, it's kind of like a three-legged stool.
Yeah.
You need all three to have the stool stay planted. Pension was number one.
Right.
Individuals, if they lived a long time, then they would rely on Social Security. And then maybe for emergencies or to take vacations, things like that, to leave money to kids or grandkids, they might have a little money in an IRA or a 401k,
Right.
something like that.
Right.
And we've seen a dramatic change.
Oh, yeah.
Where pensions are almost completely gone. And if they're still available, they're not providing what they used to.
Right.
Social Security obviously has its concerns that we've talked about here on the
Kind
show.
of a broken leg of the stool.
Yeah, so, and then it's really, if it's to be, it's up to me type of mentality, where the majority of one's retirement's nest egg and income is coming from that one leg, and that's their own individual efforts with their own individual investments.
So it's that much more important now.
It absolutely
Yeah.
is.
I think it's really remarkable too how that third leg of the stool has evolved so much. If we look back to like the 80s, that period of time, how people invested in the stock market was just stocks. That was pretty much it. And then we kind of shift to the 90s, and then they're invested in mutual funds.
Yeah.
Yeah, and then as we kind of talked about right here, fees have become such a popular topic, reducing the fees, lowering the fees. And I think what we've seen is that shift from mutual funds to ETFs, exchange traded funds. That's been a major paradigm shift in the market. And for those who don't know what an ETF is, it's real simple. Basically it's kind of like you get the best of both stocks and mutual funds. You get the low cost structure of a stock, and you get the diversification of a mutual fund. And it's been a major shift. And I think, again, like we talked about, as we help our clients into the future, I think that's going to be a trend that a lot of individuals will start using more of as that becomes more popular used investment
Well,
strategy.
I think exchange traded funds, and then also some of the other strategies or vehicles that are available that'll have some sort of guarantee with it.
Yeah.
Whether it's a preservation of principal and or some sort of guaranteed income. That's what I think you'll see more and more, in particular baby boomers as they get closer and into retirement, really wanting and demanding. And I think you'll continue to see a lot of new investments and I hate to use the word products available, because at our firm we're not driven by products, we're really driven by a process of proper planning. But to your point, in the 90s, there were more mutual funds that you could invest in than there were individual stocks.
Isn't that something?
So, mutual funds were created because people didn't know what stocks to invest in, and then they got to a situation where there were actually more mutual funds than stocks. So it didn't accomplish a whole lot. And the fees that you're talking about really drove that, because the mutual fund industry at the time, and still so today, was generating so much money on those mutual fund fees that that's what they pushed out there and really marketed to investors. And so that's what most people are familiar with. But I think if we throw another 15 or 20 years on that, you won't have the majority of individuals' money invested in mutual funds. It's going to be things like exchange traded funds, different fixed income vehicles or guaranteed income vehicles.
So for those of you that have been with us for the last 15 years, thank you so much for your loyalty. For those of you that we haven't met yet, we look forward to meeting with you. And what we found, though, is a lot of times when you go to the brokerage firms or the big wirehouses, things like that, they'll kind of do things a little bit backwards from what we would consider to be okay. So Matt, in this segment, let's talk about the planning process, because it doesn't matter what advisor or broker you're going to go to. They all have to use similar steps to get you to and through the process. But are all advisors built equally? That's kind of the issue that we want to talk about a little bit here.
I don't think so. So why don't we talk about that?
No matter who you go see, they're going to talk to you about your goals, your strategies, and then they're going to develop some tools and some plans in order to hopefully get you to your strategy. And what we found, though, is a lot of times when you go to the brokerage firms or the big wirehouses, things like that, they'll kind of do things a little bit backwards from what we would consider to be okay.
Right.
So I mean, let's talk a little bit about that. What would happen if you go to let's say one of the big brokerage houses and they have some type of quota? What's going to happen?
Well, I think if they have a quota, which a lot of the big firms do, they're probably going to start over here on this side.
That's right. That's right.
You know, what I've noticed over the years, I think a lot of advisors that are out there, before you even walk in the door,
Yeah.
they know exactly
What
you
you're going to
need.
use.
Yeah,
That's right.
exactly.
That's right. So they're going to say, okay, well this couple here, they're going to use some mutual funds, and let's sell them a variable annuity too. Okay.
Probably because they have a quota.
Yeah, exactly. So they know that this month, in order to hit their numbers, they got to sell at least $13,000 more worth of variable annuity, or $130,000 worth of these mutual funds. So now, in order to do so, well, we better figure out how these tools are going to fit our strategy. So they're going to say, we need you to take this risk profile test for us so that we can determine what your asset allocation is. They're going to say, okay, the strategy we're going to use here is going to be the asset allocation model. So you take that beautiful test and they print out your nice 20-page report that tells you exactly what you are as far as risk goes. So now they say, okay, well, now we have their asset allocation. We have the tools we're going to use. How's that tie into their goals? So they're kind of doing things starting over here and headed this way. Isn't that kind of the exact opposite?
You know, this issue that we're talking about here is something that I learned. You know, when I started in the industry, I started with a very big firm, and we were trained to go out and recommend certain things to our clients, and that we would have a weekly meeting on Monday mornings.
Yeah.
And they would bring in some guy, usually pretty excited.
Yeah.
And he would come in and he'd draw things out on the board and talk about this new product that was out there that we should go out and put all of our clients into.
Right.
And as I moved up in that firm and moved into management positions, they would kind of sit me in the corner and they would kind of say, okay, we need to have a discussion with you. Here's how things really work.
Okay.
And what you started to find out was some of the things that we were recommending wasn't necessarily because it was in the best interest of the client. It was because that's what made the firm the most money.
Yeah.
And in this particular situation, the manager in the corner office, his quarterly bonus.
Right.
So you're absolutely correct that I think this happens far too often in individuals, that they walk in the door, the advisors focus on, okay, here's these different things that we need to sell them.
Yeah.
How do we make it fit into their scenario?
Exactly.
As opposed to starting with the goals and then working your way towards which tools to use from
Now,
there.
when you founded Strategic Wealth Designers, how did you set our firm up to be a little bit different than this?
Well, everything has to be client-centered and client-driven.
Yeah.
So we have all the different tools listed here and more.
Right.
I don't really care which tool is best for the client until I really get to know them and what their goals and objectives are. So I say all the time that as opposed to us being product driven, and that's what these are all different products
Right.
that individuals can invest in, and some of them are good, but we're process driven.
Okay.
Not product driven, but process driven. You've got to first start out with what are the goals and objectives, and then work your way from there.
So what are we trying to do with the money? Are we trying to produce income or security, peace of mind? Are we trying to transition as much as we can to heirs and beneficiaries? And then from there, then we determine, okay, well, this is what we're trying to do now. We're going to try and be more efficient with taxes, or we're going to try to grow some of the portfolio while other portion of it is producing some guaranteed income.
Yeah, I think absolutely, because what this ends up creating for a lot of firms that are out there and a lot of individuals' investment portfolios is this is somewhat what I would refer to as just cookie cutter.
Yeah,
Everybody gets the same thing.
that's right.
You know, it might be a small variation here or there, but everybody gets the same thing.
Yeah.
And it's pretty much cookie cutter, whereas, you know, our client conversations can be completely different. I'll meet with somebody at 9 a.m. in the morning where income and guaranteed income for life is their number one priority. That's what they need because they had maybe a pension that went away that wasn't there, didn't provide the income that was promised, things like that. And then my 11 o'clock appointment might come in and say, well, I don't need any income. I just need to make sure I can pass as much money as I can to my kids and my grandkids.
Right.
I'll never need to take income from this money.
Yeah.
So everybody's goals and objectives are a little bit different.
Yeah. So if you have any questions about your portfolio, let's sit down and let's talk about your goals and objectives and what are you trying to accomplish into and throughout your retirement. I look forward to seeing you at some point in our office. Now, if you have this in place, what that'll allow you to do is it'll allow you to go out and take some risk with that growth bucket. So on this segment, I want to talk about when an annuity might fit into your portfolio. And I want to talk about the three different buckets of money. I know a lot of people will use this analogy, but What I want to do is in the first bucket, what we're going to call this is your liquid bucket. That's basically where you would have your bank, your checking account, your savings account. You would also have money market or CDs, things that are very liquid, easy to get to, easy to pull money out of. Typically, what we recommend to maintain in that bucket is going to be somewhere between 6 at a minimum and 12 months at a maximum in cash. So what I mean by that is if your expenses or your monthly budget calls for $3,000 a month, that's what it's going to cost you to maintain your standard of living, then what we would want is we would want to see you have $18,000 at a minimum in cash and $36,000 at a maximum in the bank or in checking/savings accounts. In the next bucket, what we're going to call is this is our growth bucket. And growth accounts, this is going to be things that are moderately liquid. You can get to it if you need to within a few days. So this is where you'll see stocks, bonds, exchange-traded funds, mutual funds. This is going to be anything that is going up and down with the market, and hopefully it's getting you some pretty decent gains, especially here recently. In the third bucket, this is where you'll call it your income or your guaranteed bucket. Now, in this bucket, this is where you're going to have your safer investments. These are things that are going to have some guaranteed income or some strategies that aren't really going to fluctuate when the market's going up and down. Annuities, fixed annuities, or indexed annuities. You can also, in the income bucket, this is where you'll have your pension or your Social Security. And what you want to do is if your expenses are $3,000 a month, then what you want to do is you want to have at least $36,000 a year in income coming in off of your guaranteed bucket. Now, if you have this in place, what that'll allow you to do is it'll allow you to go out and take some risk with that growth bucket. We talk a lot about the rule of 100 here on the show, and basically what the rule of 100 tells you is whatever your age is, that's the number you take from 100. That's the percentage of your portfolio that you want to be safe in the guaranteed bucket. So let's say you have someone that's 65 years old and they have $1 million in their portfolio. Well, they would want $650,000 in a safe bucket, in a guaranteed bucket that's producing income for them. And then with the balance, $350,000, they could have it in a combination of the growth bucket and the liquid bucket. So if you have any questions about how your portfolio is allocated currently, and just make sure that it's in the right buckets and it's serving the correct purpose for you, give us a call at our office and we can sit down with you for a free complimentary review.
Are essentially buying through the ups and downs in the market. As the market falls in value, we're not excited about it, but at least we're buying more shares at a lower cost. So over long periods of time, that gives us the ability to rally and recover quicker and get some good growth over long periods of time. Welcome to this week's segment of Strategic Wealth University. Today I want to talk about a really interesting concept, and that is the difference between dollar cost averaging and portfolio rebalancing. So I think the easiest place to start today is going to be talking about the two different things. So first and foremost, what's dollar cost averaging? That's real simple. Basically, let's say you have an active 401k or a 403b or something that you're actively and consistently contributing to on a monthly basis. What you're doing is you're dollar cost averaging. Essentially, we're getting to buy through the ups and downs in the market. So what happens with that types of strategies is whenever we are essentially buying through the ups and downs in the market, as the market falls in value, we're not excited about it, but at least we're buying more shares at a lower cost. So over long periods of time, that gives us the ability to rally and recover quicker and get some good growth over long periods of time. Now, what we oftentimes find is once an individual stops working, they don't realize that something major has happened to their portfolio or their account. And in that situation, if it's a 401k or a 403b, they've gone from what's having an active account to a dormant account. And those are two completely different strategies. It's like night and day. Basically, a dormant account is anything like an old 401k we never rolled over. Maybe a 401k we did roll over and we put it into mutual funds. But the big difference this time is that we're no longer buying through the ups and downs in the market. So when the market falls in value, we're not buying more shares at a lower cost. When the market falls in value, we just lose. This is an area in financial planning that is greatly misunderstood, and a lot of people have put themselves in a situation where they may not have as successful growth as they've had in the past when they were actively contributing to the account. So as I mentioned earlier, we want to talk about the difference between dollar cost averaging and rebalancing. So dollar cost averaging is kind of the stage when we're on the accumulation phase of retirement, when we're putting money away, when we're saving, and we're building towards retirement. Now, once we kind of get to the top of the mountain where we're retired or we're no longer working, then what happens is we're on the decumulation phase, where we're starting to use our investments as maybe income, or we're just at a different stage in life. And what happens whenever you have those dormant accounts, you want to properly structure them. And a great way to do that is to put them in portfolios where there is what's known as scheduled rebalancing, right? Scheduled rebalancing. It's real simple. Basically what it is whenever we initially set up a portfolio or we initially set up an account, there are certain percentages to where different groups or buckets of investments are in. Maybe as an example, you have 20% stock position, and then you'd have a 15% bond position, and then a small position in gold, but it's basically the different mix of the portfolio. So what happens is those investments, they don't grow at the same rate. Maybe stocks are going to grow faster than bonds, or the price of gold is going to go up faster than stocks, but they move in different directions. So what portfolio rebalancing allows us to do is to sell the positions that have grown faster than others, and then periodically rebalance them to the original model portfolio. And essentially a simple way of doing that is maybe rebalancing every 6 months or a year. But it's something that gives us the ability to kind of reverse dollar cost average to where we still get to take advantage of the ups and downs in the market. Because obviously some people want to have a little bit of risk and some people don't want to have any risk, but we want to still try to take advantage and capitalize off of the ups and downs in the market. So if you'd like more information about dollar cost averaging, check out the website. Thanks for tuning in this week, and we look forward to seeing everybody here next week for the show. Thank you.